now move their money from the banks to the capital market.
Yeah. Okay.
So
For us, it doesn't have. It is a gauge in relation to inflation and other things,
yeah.
rather than having anything. It doesn't have any regulatory implication, and when so that the banks do not have to follow the Bank of England rate at all, and so they can set. It would be silly of them to set their interest rates or the amount that they lend, the interest at which they lend to other people or other banks higher. The inter bank lending rate is usually when the rate, depending on the level of the rate, the Bank of England rate is usually lower than the Bank of England rate.
Yeah.
Now, the Bank of England rate, they don't like the term, but for us, because they are the lender of last resort, it means that it's only when they have real problem, as in the case of Lloyd's and a few other banks, that they needed to go to the, in this case, they have to go to the governor of the Bank of England, and the governor of the Bank of England would of course consult the Chancellor and say, this bank would like to be given some money because it's running into difficulty. And then of course they would have approved it, in which case we the public now become part owners of that bank, as in the case of Northern Rock, as in the case of Lloyd's TSB, as in the case of a few others that we know on the high street. Okay. But many of the financial institutions, the banks in particular, will use the Bank of England rate as a gauge. And so the gauge will be, for example, that the mortgages will be aligned to the interest rate. And so the certain type of mortgages, which are the linked mortgages, and some have other names for that, which means the same thing, is that they could be related to the interest rate, the Bank of England rate, and so it could be 0.75 higher than the Bank of England rate.
Okay.
And so that as soon as the Bank of England rate goes up, then the mortgage rate will go up by that amount. And the general lending rate would also go up by that amount. But instruments such as credit cards would not be tied to the interest rates, and they could decide on the rates that they want to achieve at any time at all, with just little notice to the customers and clients.